You've seen the reaction to that G20 meeting. We've got that the gold price strengthening really on the back of a weaker dollar. We also have the rand strengthening, but back below 6.90 against the dollar. So it looks like it's everything back as it was before the last couple of weeks.
Hi, Stephen. Yeah, I think what we saw towards the end of last week was a little bit of positioning taken off the table pre-G20 in case there were any surprises coming out of that statement. And the market's really taken heart that for now, in any case, they've kind of managed to avert a trade war, active devaluation of currencies, except, of course, when that comes to China and to an extent now the US, depending on their QE. So, the market has taken a bit of heart. The dollar has fallen, gold has risen again, and we're back to the status quo about a week ago where emerging markets would do very well, particularly if China allows the yuan to strengthen over the next few sessions.
Of course, you talked about the competitive devaluations that countries have decided not to go ahead with those in the meantime, but importantly, Brazil wasn't present at this weekend's meeting, and of course Brazil is one of the countries that has been in the market trying to actively devalue their currency. So do you think that the agreement over the weekend will hold water going forward?
Yeah, I think the real test will come when there's some pressure on economic growth in these individual countries, and you mentioned Brazil. They've instituted some measures there to try and stop their currency from strengthening dramatically. We'll have to see as numbers come out, but this is very, very important as far as global trade and global economic growth is concerned, because arguably that's what pushed us into the Great Depression of the 1930s, when countries around the world adopted these easing measures and these protective measures, and trade all but dried up. So I think they're very cognizant of that, and they're trying to hold off as far as that is concerned.
Well, we had US Treasury Secretary Timothy Geithner putting forward a proposal that countries target their trade accounts to try and rein in massive surpluses or massive deficits. And this is something that's going forward to the next Heads of States G20 meeting in Korea next month. Do you think this is something that can be achieved, that countries will be open to?
Stephen, it's going to be very, very hard. One of the things that monetary authorities around the world are very, very conscious of is the fact that these imbalances need to be sorted out so that we can avert any future crisis developing from them. How to do it, of course, is the crux of the matter, because you've got current countries in Asia with massive current account surpluses, others around the world with current account deficits. That's all been premised on the fact that countries have been trying to export their way out of trouble, not only in the last couple of years, but for decades. So those imbalances have been building up over decades. It's going to take a very, very long time to fix. And I guess, Timothy Geithner and others are trying to tread lightly to try to address these imbalances and also covertly put a little bit of pressure on China to allow their currency to strengthen, because that will ideally sort out some of the imbalances that they're talking about.
And of course, ahead of the weekend meeting, we already had Germany and Japan both voicing their concern about this trade account targeting, because of course both of those countries do run large trade surpluses, but both put it down to their competitiveness as nations rather than the currency.
Well, I think that's the point. You've got there's so many factors that influence where a currency trades that to just target the current account deficit or surplus as it is, is going to be very, very difficult to do, because competitiveness is an issue, labor prices are an issue. There's so many things that are factored in, and that's why it's going to be very, very hard to sort out in the short term. But it needs to be spoken about. Imbalances need to be addressed so that we can avert future crises.
David, here at home we had the leading indicator out a little while ago, and it's fell by a smaller than expected 0.1% month on month for August, down a little bit more, 18.88% year on year. But it did come out a little bit better than expected. Now, this of course looks at the manufacturing sector, at trade conditions in South Africa. What would it suggest to you that the rand hasn't had such a big impact on the sector?
Well, Stephen, when you look at the rand against the dollar, yes, we've had a very, very good run. Against other currencies, we fared less well, although the rand has strengthened over the last sort of 18 months. But on a trade-weighted basket, it's not as dramatic as it would appear against the dollar. So from that perspective, our trading partners, we have been expanding the number of trading partners. The US perhaps not as important as it was 10 years ago. Certainly Europe lessening in importance, and our trading partners in Asia, they're growing from strength to strength. And I guess that's where the speed is coming from.
It's a very busy data week. We have CPI out on Wednesday. We also have trade and credit numbers later in the week. And of course, the medium-term budget review coming out on Wednesday as well. What's the market going to be looking for in that medium-term budget?
I think from a data perspective, we're looking for anything that may indicate that a rate cut is around the corner. So CPI will certainly be important as far as that is concerned. From the medium-term budget framework, we'll be looking for any statements re the management of the currencies. That could include anything from taxes that, like Brazil has implemented, to exchange control relaxation. So we'll be looking to those statements to see if they're trying to manage the currency a little bit weaker. Quite frankly, I don't expect any measures to be announced, any dramatic measures to be announced, because whatever we do, we have to bear in mind that the rand is notoriously volatile, and in periods of strength, certainly it hurts us, but when the rand weakens, we need those inflows to finance the current account. So I don't expect any major changes. From a market perspective, we'll be looking for anything that may indicate a rate cut in the next couple of weeks.
How about the budget deficit for this year? Because it looks like revenue collection has been a little bit ahead of expectations. Of course, with all those public sector wage increases, it looks like spending could also be ahead of expectations.
Yeah, I think the Minister of Finance has indicated that tax collection has been better than expected, but we do still expect the bond issuance to remain high. Certainly in the face of the unemployment that we do have in the infrastructure projects that the government would like to implement. So we don't see any major changes as far as bond supply is concerned into the market, even though we've seen some better tax collections.